Magnificent Seven in the US and related stocks and semiconductors have done very well. And then the rest of the market hasn't performed. The value stocks haven't performed well. And in emerging markets, we had actually poor performances. So if you look at the period 2010 to today, what is striking is the incredible outperformance of US equities driven by the Magnificent Seven and FANG stocks, and the underperformance of emerging economies, as well as European stocks. Last year, European stocks did better, but in principle, for the last 10 years, they have grossly underperformed the US. So we are dealing with two economies. We have the economy of the rich people that benefit from asset inflation, and we have the economy of 70% of the people who do not have assets in a significant way, and they've been lagging behind because their cost of living increases exceed the income gains. Ordinary people have been suffering, and they are worse off than in 2017, 2018, 2019. So the markets are similar in the sense that we have a narrow group of stocks that have performed superbly, and then the majority of stocks, including, say, mining companies, they have performed miserably. That is very interesting from my point of view, because I'm negative about the Magnificent Seven and these popular stocks in the US. The most popular stocks held in individual portfolios are Tesla and Nvidia. And both companies are of questionable value because we don't know much about the future value of these companies. And also we know that they're very highly priced. Now, the rest of the market, which is neglected, say emerging markets, including also Latin American markets like Colombia, Brazil, Argentina, and so forth, they are now, in my opinion, becoming relatively attractive because they've been going down and there is value now in these markets, whereas the Magnificent Seven I would avoid. I would sell them. The Magnificent Seven in America, they have a stock market valuation that is higher than the stock market of China. I mean, all the exchanges combined, and Hong Kong and Taiwan. So, you're dealing with a huge valuation divergence. And I, as a contrarian investor who likes to buy what nobody likes, I like Chinese stocks, but there are different ways to play it. You can buy Chinese stocks, technology stocks or value stocks, and you can buy Hong Kong shares that in a Chinese stock market rally would probably outperform, especially Hong Kong property shares, because they're selling at a huge discount to the net asset value. Now, the net asset value will go down because property prices in Hong Kong will not go up in the near term. But I think that the media in the Western world and the politicians are excessively negative about Hong Kong, the outlook for its property market, and excessively negative towards China, when the whole world actually needs China because China has a huge industrial production. As an example, China produces more cement than the rest of the world combined. So it's a very important industrial power. And if China didn't exist, I can assure you that all the goods that we buy would be significantly more expensive. The market is telling investors that central bankers are idiots. They cut the rates in an inflationary environment. You and I, as a bond buyer, want to see tight money, and we want to see that the government or the Fed or the authorities are determined to kill inflation. We don't want to see easy money, plenty of liquidity that will fuel inflation. And then, of course, we have to define what is inflation. For the US Federal Reserve, inflation is when the price of potatoes and carrots and other food products go up. But for me, Rising property prices, rising stock prices are a symptom of inflation as well. It shows that there's plenty of liquidity in the system. Otherwise, bitcoins wouldn't go to 100,000. So basically, the Fed controls short-term rate, but they don't control the long-term bond market. And the policy of the Fed is actually destructive because the long-term bond market is very important for capital spending. And especially the government has to borrow money. And some economists in the US say, well, the government debt doesn't matter. But no, it does matter because now is already over $1 trillion in interest expenditures every year. It's larger than all the defense spending. It's larger than discretionary spending. And in my view, the Fed has maneuvered itself in a very unpleasant situation. And let me explain to you why. The Fed has, over the years 1980, the bond market made a low. The interest rates were at the highest when the 10-year Treasury was over 15%. Deposit rates at the time were 20%. Since then, interest rates have gone down, and the Fed then pushed interest rates artificially low in the period 2018 to 2020, and they didn't realize that inflation was accelerating. So the 10 years fell to 0.53% in August 2020. Since then, inflation has been accelerating upward, and consumer prices have been rising, and also interest rates have been rising in a long-term cycle. Now, can we have for the next 6 months interest rates coming down somewhat because there is a recession? Yes. And how do we get the recession? In my view, if asset prices go down, other words, housing prices and stock prices and cryptocurrencies and so forth, the wealth effect will be very significant and people will cut down on their discretionary spending, and that will lead to a recession. And in that environment, I think interest rates can go down. But I don't think they'll go down to zero, as we essentially had in the years prior to the COVID. I think we may drop to 4% on the 10 years or 3.5%. But even at this level, 4.7% you mentioned, interest rates are not very high by historical stand. I started to work in 1970. Interest rates on long-term bonds were over 6%. They went already in 74 to 9%. And then they dropped again. And finally, they peaked out at 15.84% in September 1981. When I started to work, and in the 70s, the stock market capitalization as a percent of the economy was 25% in America. When you have a small financial market and a big economy, when the financial market goes down, it doesn't have a very negative impact on the economy. But nowadays, the stock market capitalization in the US is something like 160% of GDP. In other words, the financial market is this big and the economy is this small, and the speculation is huge. The volume of options and so forth is enormous. So if that contracts, then it will have a very negative impact on the economy. No household lives with a 2.7% inflation rate. Most households, they live with an inflation rate. And by inflation, I define this as the cost of living increases, because there are many different ways how to calculate the price increases, inflation. The government lies about inflation. They understate inflation widely. John Williams, he publishes the shadow statistics. He has an inflation rate of over 10%. My inflation must be between 5 and 7%, something like this, but never 2.7%. Look, in America, what is expensive? Car insurance and house insurance and interest rates. Again, for the poor households, they have debts, okay? So when interest rates go up, the poor households, they suffer. The rich people like we have deposits. I pray every day that interest rates go up so I get a higher income on my deposits. We are in war times. We have war in Ukraine and we have wars throughout the Middle East and so forth. And wartime economies, they all have higher inflation rates. There's no question about this. And two, you hinted at the trade war. I mean, I don't think that Trump can implement his tariffs because usually there are too many exceptions in the US. And if I look at the composition of his cabinet, the ministers that he appointed, all of them are like billionaires, rich people. Do you think that they want stocks to go down? You must be joking. They all want stocks to go up. And so the policies of Trump, in my opinion, will be watered down significantly. And I will not rule out that, the US realizes, Trump, I have no great admiration for his intellect, but he's a street smart guy. That he makes a deal with China, you stay away from influence in the Middle East and in Ukraine and so forth. So we kind of divide the world between China and the US, and we are on friendly terms. I wouldn't rule that out. And Mr. Trump, I can build a few hotels in China.